So, ladies and gentlemen, a very good morning to all distinguished guests, speakers, organizers, and participants joining us today on the introduction to quantitative finance, what quants really do, proudly organized by the CFA Society Malaysia together with the Youth Ambassador 2026. My name is Jason, and I will be serving as your MC for today's session. Moving on to today's agenda, we will start with our introduction, followed by the info session, expert insights, and a Q&A session. Today's webinar aims to provide participants with an introduction to quantitative finance and offer insights into what quantitative professionals, or quants, really do. Whether you are interested in the asset management, algorithm trading, data science, machine learning, risk management, or investment research, today's discussion will help you better understand the skills, tools, and career pathways available in this rapidly evolving field. Today, we are also privileged to be joined by three highly accomplished industry professionals who will be sharing their experiences and insights with us. So our speakers today are, first, Mr. Ting Yuan. Ting Jing is a co-founder and chief operating officer at Optimus Sendirian Berhad, the first Bursa licensed information vendor that leverages AI-powered stock analysis capabilities. Moving on, we have Ms. Voon. So Yiping currently heads the Digital Investment Management Department at Kenanga Group, where she oversees the Kenanga Digital Investment, or KDI platform. And lastly, we have Mr. Chan Han-Chin. So Han-Chin currently serves as the Director of Portfolio Strategy at Fintonia Group, where he leads investment strategies for crypto multi-strategy funds, portfolio allocations, and risk management. Thank you to all our panelists for joining us this morning. Without further delay, we will now proceed to the panel discussion session. To kick off the discussion, I would like to invite our moderator, Brandon, to take over and guide us through today's conversation. Brandon, the floor is yours.
Thank you, Jason, and a very warm welcome to everyone joining us today. I'm Brandon, and I'll be your moderator for today's panel discussion. But before we dive into our panel discussion, I would like to quickly run through our agenda so everyone knows what to expect for our panel discussion. So we'll be kicking things off with our first topic. What is quantitative finance? Then we compare the expectations versus the reality of working in quant finance. And after that, we look at the specific skill sets needed for the quant industry. And finally, we'll wrap up with actionable advice from all our panelists themselves on how to break into the industry. So without further ado, let's dive right into it. Our first topic of the day, what is quantitative finance? So actually, I wanted to direct my first question to Miss Yiping. Miss Yiping here, she has a unique background as she used to work as an equity research analyst before transitioning into a quantitative portfolio strategist, and now as the head of digital investment management or under Kenanga Group. And to be frank, that is a really impressive achievement. So my question to Miss Yiping is, for an audience that might be completely new to quantitative finance, how would you describe what a quant analyst does on a day-to-day basis? And what is the most important thing that separates how quants view the market as compared to a traditional equity research analyst?
Okay, so thank you for having me here, and thanks, Brandon, for the question. So for quant side, and I'm just speaking from a portfolio side, what we do is a factor modeling type of kind of quant model. So there are various kinds of quant models, but for us, what we do is more on the portfolio management. So what we do here is, if you kind of go through it in classes or from doing the CFA syllabus and all that, it's actually quite similar. So actually look for useful market factors, and factors here means things like economic indicators or individual stock indicators, or it can be all kinds of data, even alternative data as well. So we put these all together to find what is helpful or indicative of a potential performance of an asset. Can be stocks, can be ETFs, can be various kind of things. And once it's put together, then basically you have a view, and you have a view which you can then use for portfolio to basically overweight and underweight and create a investment portfolio to maximize alpha or minimize risk for whatever various objectives you might have for that particular model or portfolio. So this contrasts a little bit with a traditional analyst role because analysts are very stock specific. So equity analysts actually go very deep into what constitutes the drivers of the stock. So they are supposed to predict, looking at the past, looking at all the information you've gathered about the stock to predict what may be the key drivers. Could be sales, could be costs, could be growth, all kinds of things, and then come up with a target price for very specific stocks. So very roughly, right, I would say that quantitative is more generalist. It's more looking at average model and what on average the stocks might the stocks of the portfolio might do, compared to traditional analysts who would be very specific and very knowledgeable about single stocks.
Understand. Thank you. That is a really great insight. Mr. Hanjin and Mr. Ting, do you have anything to add on, or perhaps, a completely different take based on your experience?
So I guess like what Yiping has already mentioned, quant analysts review things in terms of factors. So it's not so much about looking at individual companies. It's more about what are the characteristics which drive a group of companies. So I think like in terms of a portfolio kind of view, for fundamental analysts, you basically, when you buy stocks, you expect them to outperform. You expect all of these stocks you have done proper due diligence. But in terms of quant portfolio management, it is quite likely that you will be holding a very broad set of stocks. It could be something like 100 names in your portfolios. So you cannot afford to basically go through due diligence on each single company. Because when you are having a large number of stocks, it's not really so much about whether each of the name outperform. It's more about whether the factors which are inherent in these companies, whether they lead to outperformance for this set of stocks. Yeah, that's what I wanted to add. Thanks.
Awesome. Thank you, Mr. Hanjin. How about Mr. Ting? Do you have anything to add on?
Echo with Hanchin and Yiping, traditional analysts, their unit is the company. So they are thinking like, is this one company good? While quant is normally the unit is about the pattern. So they are looking into pass through patterns, factors, and then to prove that the pattern will give them an alpha or a better growth in their portfolio. So to add on, I actually come across, because local quant and foreign quant is quite different. I have friends in foreign quant company, and because quant itself is actually a very big area, and they actually break down quant into different role. So it's not just a single quant that you need to do everything. So quant finance is a big umbrella of a lot of stuff. And within it, like what Yiping mentioned, factor investing is actually one of the pillar where you come into looking into what to buy. But then normally as someone new to quant, people may get confused. And one of the questions that we will ask very frequently is, what's the difference between quant finance, algorithmic trading, and also factor investing? So I would say that quant finance is the big umbrella, and then within it, if you want to know what to buy, which is the factor investing, and for algorithmic trading is how do you execute it? Because as a quant finance, you need not to know everything, because there are different roles within a company to complement to make your quant finance operation useful. For example, in a quant finance team, you may have research quant, where the quant actually research for strategy, research for different signal for based on the data. And then you will have algo infrastructure quant, where to make the entire infrastructure smooth. And then you will have maybe a front office quant, where they are looking day-to-day operation to ensure that everything goes smoothly. And also you may have risk quant, where you are looking into certain risks of the portfolio or whether anything goes wrong. So to compare traditional analysts and also quant finance analysts, I actually break down into three different pillars. One is systematic versus discretionary. So quant finance goes with the systematic one, which means that everything is rule-based. If this happen, then this and then this. So everything is automatically systematic. While the traditional analysts, they will go by decision each time, which is discretionary, where they will make judgment based on a human. So one is computerized and one is human. And another pillar is fundamental versus statistical. Fundamental, we are looking at story and substance of the individual company. So traditional analysts will look into fundamental, where they actually look at earnings, management, products. While for quant finance, we are looking into patterns, which is the statistical analysis. And the third pillar is actually concentrated versus diversified. Concentrated means that traditional analysts, they are looking into one company, and they need to ensure that the one company perform and is a very big allocation towards the concentrated stock. While quant finance analysts, they are looking into diversified spectrum, where they may be going into 10, hundreds of stocks or instrument to be able to actually find the alpha. So a very good investor for this comparison will be, you will think that Warren Buffett is the one that's doing the analysis one, the traditional analysis one, while for quant finance, a very good example will be Renaissance. Yeah, so comparing these two, for me, there's these three pillars as a differentiation of the two. Okay, I'll pass you back to Brandon.
Wow, thank you, Mr. Ting, I love that perspective. Thank you. I actually have another question I would like to ask Mr. Hanshin. So for context, Mr. Hanshin's role at Fintonia Group, it involves macro, quantitative, and derivatives trading. And you see how markets work every day, is it, Mr. Hanshin?
Yeah, so in our firm, we run a very different kind of strategies. So our focus is mainly on crypto market neutral strategies and also option trading strategies. So basically, this basically involves doing arbitrage trades. So it's sort of like similar to the kind of carry trades that you see in terms of like how you borrow the yen, and in the past you borrow the yen and then you buy high yielding assets. So in this case, crypto market neutral is simply you buying the Bitcoin spot and you shorting the perpetual futures to earn the yield from the perpetual futures, where basically this yield relies on supply and demand, whether more people are going long on Bitcoin or more people are going short on Bitcoin. So basically this in terms of market neutral arbitrage. Of course, we also run different other option trading strategies. Basically, it's also a kind of yield generating strategies where you sell options. You could sell call option and sell put options for you to generate the yield. So basically, you are harvesting the option premium whenever there's an increase in volatility. So yeah, it's quite a different kind of I wouldn't call it so much in terms of investing strategy. It's probably more in terms of trading strategies. So it's quite different from the role that I have run in the past, perhaps 10, 20 years. I've been focusing more in terms of factor investing strategies, equity, in quant investment strategies as well. Yeah.
And thank you, Mr. Hanchin. To follow up your question, you mentioned that it's more on trading instead of investing analysis. So for a follow-up question, so university, for example, students like me, for example, we always thought that markets are rational and that good analysis gives you good results. So based on your experience, again, how much of what happens in the market can a computer model actually explain? And where does a model just completely runs out of answers?
Yeah, I think this one, in terms of the context of investing, we always have a very limited historical data. So this, unlike when you look at those kind of like consumer loan models, where you have a large set of data for you to fit. So basically, when your historical data are very limited and you are trying to create models with a lot of parameters, of course, tendency is that you will kind of find the right set of parameters for you to have a very good model which have a very high R square, able to explain the historical data very well. Let's say if you fit to 5-year historical data. But because your historical data is very limited, then you are basically tend to overfit your data. So in this case, your model fits very well, but then it really depends on what kind of historical data that you have been fitting to. Maybe over the past 5 years has been a bull market, so you are just fitting to a trending market. So in that case, if there's a change in terms of the market regime, let's say we goes into a bear market, or the Fed starts raising rates. So all these kind of structural changes in terms of the markets means that your model may not work anymore. So I think usually the case is if you have a more complex model, then you will be able to explain very well. But when something happens, some shift in terms of the market structure that is not captured by your model, then it tends to break, and sometimes you wouldn't even know what's the reason which result in your model not working anymore. So I think it always comes to a kind of course, there's some quantitative ways for you to look at maybe your alpha starts to decay, maybe you have a number of factors and you can look into individual factors and you see that some of the alpha has started to decay, or sometimes human judgment may come into play even quicker, because basically the regime change. Your model was not fit to this particular market regime. So I think there's some sort of human judgment could be involved, and there also can be ways that quantitatively speaking, we may be able to see maybe there's a change in terms of the regime. So yeah.
Thank you so much, Mr. Hanshin. That gives us the perfect baseline for an introduction to quantitative finance. Moving on to our second topic for today, expectations versus reality in quant finance. This is actually a topic I'm looking very forward to. So when students, for example, like myself, study finance in university, they often arrive at their first quant role with very specific expectations and ideas of what quant finance looks like. But the real world could be a little different. So I actually wanted to direct this question to Mr. Ting Jing instead. Mr. Ting Jing. Mr. Ting Jing is not only the Chief Operating Officer and co-founder of Optimus, but he is also a quant strategist and algorithmic trader. So for context, Optimus is a machine learning and alternative data company that applies machine learning algorithms to predict stock movements for successful investment decisions. So, Mr. Ting Jing, looking back at your personal career, what surprised you the most about the actual working experience in the industry, in the quant industry, compared to what you expected as a student? The floor is yours, Mr. Ting Jing.
Okay, so for quantitative finance, we are looking into three areas of studies. One is finance, mathematics, and programming. So when I was student, because I actually studied the CQF, and to my amaze is quantitative finance is the least emphasized one within the studies, and most of the studies involves around mathematics and also programming, where you need to come up with a model to be able to predict, or even machine learning model, so going through the maths of all this stuff. And then programming, of course, is also very crucial because we are looking into automation, or even capitalize what you are thinking and making it into something understandable by the computer. So finance was the smallest part of the three area of studies. So when I get to industry, especially in Malaysia as a context, the assumption about a lot of the market actually breaks. For example, when I was doing my thesis for CQF, I was actually doing the pair trading. Pair trading means that whenever we want to long one instrument, we actually need to short another instrument to be able to profit from the spread between these two lah. And it works for commodity future or any other kind of future. But then when it comes to Malaysia, then definitely there's a war in front, because Malaysia, if you want to short, you need to have regulated short selling license. Otherwise, you are only doing intraday. Intraday is not so viable lah, because you are looking into pair trading. You may not do it within the day, and you may need to hold overnight, which is only allowable if you have a regulated short selling. So everything, the assumption during my studies, a lot of them does not apply to the real world. So if you want to apply, then you need to look into your market, whether it works or not. So actually, it's actually from two perspectives. When I studies, you are looking into strategy first, and then you are trying to backtest. Then you want to apply it in the real world case. But coming to a real world is actually, we are flipping it around. We're actually looking at what are the boundaries given to you, like what are the liquidity, what are the different kind of restriction that are given to you. So with all this restriction, then only you can craft your strategy based on the boundaries. So I would say that is very different comparing studies and also what really apply in the market. Of course, if you are applying it in the foreign market, crypto or ETF, then you have more leeway lah, which means that you are able to be more flexible. But if you're applying within Malaysia, then there are kind of some restriction that you need to know about it, so that to craft your strategy based on all those boundaries. Yeah, I hope that answers the question. I'll pass back to you, Brandon.
Yes, thank you. That very much answers my question. Thank you so much, Mr. Ting Jing, for sharing all that. It's a valuable insight. So, how about Miss Yiping and Mr. Han Jin? Do you have anything to add on, or perhaps a little, maybe a different perspective from what Mr. Ting Jing said?
Yeah, so I'm going on a slightly different angle here. So yeah, definitely at academic level, right? A lot of the things you learn is not Malaysia centric because Malaysia is such a small market compared to global. But another side of it is that you're not prepared in your studies when you come back into when you come and work in the real world, right? You are managing real people's money. And as someone with this responsibility, right? So you have responsibility to your client. And that's not something that academic prepares you for because then you have to answer to expectations and basically have real responsibilities. So that's the small thing that I want to add that to really succeed, then you actually have to be able to meet what your client expect of you. And maybe you don't study that in school. Yeah, thanks.
Thank you, Miss Yi Ping. How about Mr. Han Jin? Do you have anything to add on?
Yeah, actually echo what Jing shared in terms of short selling. Because even in a lot of markets, such as emerging markets, short selling is always a pain. And there's also a borrowing cost for you to short sell as well. So basically, when you run these kind of strategies, you also have to think in terms of what's your borrowing cost for you to short sell the stock. So, and also one of the reason is when we look at quantitative strategies, a lot of time you are trying to make not only from the long side, basically you are thinking about it in terms of factors. Good factors will mean that stocks with a high exposure to the good factors, they will tend to outperform stocks which has a negative exposure to this good factor. So you are basically trying to harvest from both long and the short side. And even when you run factor back tests, you can see that your top quintile, basically your stocks with exposure to the good factor, will always outperform the stocks with a negative exposure to the same factor as well. So this is the kind of things that in traditional asset management firms, usually it's quite hard for us to have both the long side and the short side. So most of the time we are just looking at long only exposure, which kind of limit your potential returns from your quant models. So I think basically one of the expectations as a student also, I always think that when you come up to work in the real world, it's about building sophisticated models, and then you can have like a black box models and this kind of models which can outperform the market strongly, and then you don't have to explain what's going on behind the model as long as it outperform. But obviously, in the real world case, it's not about it. Especially in traditional asset management firms, it's always about communication. You will need to let your stakeholders know what is going on behind your model, and a lot of the time you find out that simple models sometimes can do the job better, especially in terms of explaining what is going on, and also you understanding the model and when the model may not work anymore. Yeah, that's the ones I would like to add.
Thank you, Mr. Han Jin. That is an incredible reality check on the expectations versus reality in quant finance. Actually, I have another question, but this is for Miss Yi Ping. Miss Yi Ping, because since you are the head of digital investment management at Kenanga Group, right? So I want to ask, digital wealth platforms like Kenanga Digital Investing, for example, which you currently are the head of, make it incredibly easy for the public like me, for example, to go on board so I can just invest on any type I want. But it also means that I can withdraw my funds just as quickly as a single tap. So from a quant perspective, how does liquidity management change when, systematic models have to, handle sudden, unpredictable capital outflows? Like a lot of people suddenly want to cash out at a single moment. The floor is yours, Miss Yiping.
So actually, the models themselves don't have an issue. It's all theoretical anyway. So to the model itself, it doesn't really care how much huge amount of money is there or not. The practical reality is that you need to quote certain risk kind of tolerances inside. So you may have to have certain amount of cash on hand because you need to meet the withdrawals in the timeline that you've given. But the bigger part of it is actually having a robust kind of operational workflow. Because we are doing retail product, right? So we have promised that, okay, if you do a withdrawal, you get it in so and so days. If you go a deposit, you see it in your account in so and so days. So that part on the operational cash flow side, then you need to have a robust team behind it with very good internal daily practices, daily process, and all these strict daily timelines. It's not so much about having it managed in the model. Actually, this is something external already when it becomes part of just day-to-day operations management of cash flows. So take cash a little bit differently from the model part, because the model part can handle a lot of money, very little money. It's all the same to the math. But when it comes to the real flows, then it's all human dependent, timeline dependent, and having a good team.
Understand. Thank you, Miss Yi-Ping, for the wonderful insight. That actually leads us to our third topic for today. It's quite connected. Our third topic, skill sets needed for the quant finance industry. So, okay, this is an open floor, so everyone can answer, all panelists. So our main question for our fellow panelists is that for students and young professionals like me wanted to get into quant finance, the technical entry barrier could feel a little bit scary and intimidating. So if a motivated student wants to start prepping for a career in quant finance tomorrow morning, what is the one foundational skill, be it technical or otherwise, that you would tell them to prioritize above everything else? And why does the rest of the job build on top of it? Does anyone start first? Okay, how about this? We'll go with Mr. Ting first, and then Mr. Han Jin, and then Miss Yi-Ping. And would that be okay?
Okay. So actually, I will not name a technical skill to learn. It's actually something that is very relevant to all of us, which is to the skill that actually teach yourself the next thing. In any topic, including quantitative finance, is a very broad area, and at first you may think that it's very daunting, but then you are not expected to learn everything in a go. It's not a sprint. It's more on like a marathon. Even for your career or for any area you want to dive in, it's a marathon. So the skill of teaching yourself the next knowledge is very important. So for example, nowadays AI is very accessible to all of us, and coding, mathematics, all this can be resolved with AI. But then the thing is you need to learn the knowledge first. And apart from just dive into doing whatever backtesting, whatever signal generation, the learning is the thing that you guys need to go through first. So used to be you may, and to be able to learn, you need to keep yourself accountable lah. So for example, if you want to go through examination, then you can go through qualification like CFA, CQF to equip yourself with, to make yourself accountable by the exam. But the real thing is the how do you learn using AI now? Because AI, you can actually find information very easily, but you need to get all this information sticking in your brain. So why is it important? Because for like quant finance, you are doing ideation, you're doing back testing, forward testing, go through the entire spectrum. A lot of things in the middle part can be solved by using AI. But as a human, we still need to have the ideation part, which we need to come up with the idea for factor. We need to come in whether a new factor or improvise the existing factor. And after the AI does the job, you will need to actually know whether they are doing it correctly or not. So the front part and the end part actually is the human thing that you need to perform. So for a start, I will say that you do not need to optimize what you know in day one, but then you need to have a skill that can teach you to learn the next thing, because knowledge, information may be obsolete. What you learn tomorrow may be obsolete in the next 1 year, but then you need to get yourself involved in learning, because I do understand that when you are getting into a new knowledge or new stream, you may be feeling very daunting. But then once you dive into it, especially with the use of AI, you can actually flip it around and turn the intimidating wall into a to-do list. Like you just list out one, two, what you want to learn, then you go through one of the learning model, because in learning framework is actually Bloom's taxonomy. And going through a Bloom's taxonomy, you can actually particularly learn anything very quickly and more efficiently. So I would say that it's not a particularly area of the quant finance, but then it's more towards a skill set you can teach yourself anything that's available in the world. And yeah, so that's my perspective. Okay, back to you.
Thank you for breaking all that down, Mr. Jing. I love perspective. Now let's go on with Mr. Hanchin's take on this. The floor is yours, Mr. Hanchin.
Yeah, I agree with Mr. Ting that AI is very helpful in terms of for us to learn new skills. Compared to 10, 20 years ago, it's so difficult. Sometimes it's just so difficult for us to access knowledge. But with the advancement in terms of AI, it just makes our lives so much easier. But then, as Mr. Ting has also pointed out, foundational skill set is very important, because whatever come out from the AI, there's no guarantee that it is correct. In fact, there's just ways that AI could just go wrong. Maybe either the prompt was a bit biased, and maybe the prompt need to be adjusted properly. So there are many ways that AI could still go wrong. So you still need the foundational knowledge and not just blindly accept what AI spits out. I think in terms of foundational knowledge, I would focus more in terms of statistics, because from a quant point of view, it's always about, I think what's most important is about probabilities, whether you are understanding risk reward of the trade. So, and then whether the results are statistically significant, or basically, it's just noise, because in the real world, especially in the financial markets, there's information is just so noisy. So tons of information, tons of parameters that you can use to fit your historical data. So you kind of need the correct mindset to really evaluate whether you have really found something which is really it's a pattern, or is it just noise? Yeah. Pass back to you.
Thank you for the wonderful insight, Mr. Hanchin. Now let's have our final panelist, Ms. Yiping, share her thoughts on the skill sets needed for the quant industry.
Yeah, I think actually, other panelists have covered a lot of this. And yeah, certainly statistics is very important, and some of the important concepts I think is the most useful to have a good grasp on. So things like why you don't want to overfit your model, and then how you want to basically prevent correlation or spurious correlations and things like that. All these concepts are very important when it comes to having a model that basically works in many conditions. You minimize the risk of it backfiring or having a ability to maximize certain aspects and things like that. So understanding is very important, almost more important than like doing the coding itself. Coding skill is one thing, and like I think with AI nowadays, a lot of the effort can be reduced, not removed, but reduced, because at the end of the day, you still need to understand what your model is doing in your code, what every line of code does before you actually put it into practice. Otherwise, there's a lot of risk for it to backfire in ways that you don't know, very new and exciting ways lah. So having a good understanding of the concepts is very important. And coming back a little bit to what Mr. Ting was saying about learning, right? So AI is just one of the source of learning, and to really understand a topic, like even in school also, like if your teacher tells you something, but you also are very curious, you want to expand your knowledge, you don't only listen to what one source tells you. It's good to have that curiosity to basically find from all the possible sources that you can knowledge about something, to have a real understanding. And that's what's very, very valuable for, I think, having a successful career in quants, to have a good understanding of the important skills, of the important concepts, and then being able to apply it correctly.
I love that. Thank you, Miss Yiping. Since we have a little bit more time, I actually have a question for Mr. Hanjin. So, Mr. Hanjin, I wanted to ask, before taking on your directorship at Fintonia Group, you spent years as a quant manager and researcher, as well as in equity derivative sales, Maybank and CIMB, two of the biggest banks in Malaysia, am I correct? So, I wanted to ask, what is the hardest part about taking a theoretical strategy that looks great on paper and actually trying to making it work with all the tight rules and regulations by the central bank, which is Bank Negara Malaysia, in place? The floor is yours, Mr. Hanjin.
Thanks, Brandon. Yeah, of course, theoretical strategies, it's easy to create something which always outperform on paper, but when it applies on real world, then you have to think about many other things. One thing is about basically clients' understanding of the strategy. Of course, if those has been properly marketed as a quantitative strategy, I think it's still quite difficult when if clients are not does not understand the strategy very well, because as we all know, in the traditional asset management firm, basically it's a lot about individual stocks, due diligence on single stocks. So when you go to talk to clients, they will always ask you, show me your top 10 holdings. What's your top 10 holdings? And then they will look at your top 10 holdings, look at each name, and then ask you, why are you holding this stock? This stock didn't seem to outperform over the past 1 year. And let's say you are saying that, oh, this is a quantitatively managed fund. You will have to tell them you are holding a broad 100 names. And then maybe the question could even come back and say that if you have high conviction in your model, why aren't you holding like 10 or 20 names? If you are holding so many names in your portfolio, does it mean that you don't have conviction in your model? So I think it's a lot about education as well to clients about the alternative way of managing the portfolios, which is basically in terms of quant kind of portfolio management. So that's the part that in terms of client communication. Then of course there's also other aspect, which is implementation problem. So when you run your back test, if let's say you are doing something like a weekly rebalancing strategy, and it seems to looks good on paper, but when you are going to implement in the real world, how are you going to do a weekly rebalance when you have buys and sells? And when you are managing a portfolio, which let's say includes stocks in different markets, different countries, you will have to wait for sometimes cash settlement. You have to have the dollar, US dollar, for you to trade in different markets. And you could also have emerging markets where you need to have pre-funded currencies. So these are all the operational complexities. And this will become even a bigger problem if you are managing, of course, if a Sharia compliant fund, you may even have greater restrictions in terms of whether you can have a kind of credit line for you to deal with the difference in terms of the settlement. Because if you buy a stock, if you sell a stock, you don't get your cash today because of the settlement delay. So these are the kinds of things in terms of cash flow management that you will have to think about it, whether you can even do a weekly rebalancing or not, or maybe a monthly rebalancing strategy would actually fit the real world scenario better. So I think to conclude, it's basically about whether your strategy can be understood by clients and whether you can execute your strategy based on your model. And of course, finally, it's about whether it's compliant with your investment mandate or not.
Understand. Thank you, Mr. Han Chin, for all the insights given. I still have another question for Miss Yiping, since we have a little bit more time. So, Miss Yiping, since you were a quant portfolio strategist previously, Kenanga Group also, I wanted to ask, machine learning nowadays is now the baseline expectations for graduates rather than something that sets them apart in the job market. So, from what you see at the market today, the job market, any market, what is the next big capability gap that separates genuinely strong applicants from those who simply completed an online course, for example, on LinkedIn or somewhere online? The floor is yours, Miss Yiping.
Actually, I don't think that there's a problem or there's anything less about doing courses online. Because sometimes you just have to pick the right things. Like it's not so much about it's online or the mode of kind of learning lah. It's actually whether they have taken the right courses that will basically be able to equip them to for the kind of future needs for kind of quant earnings. But that said, even if it's a pretty new industry, but it's still pretty well established. A lot of the principles are out there to be learned lah. The main thing on machine learning is after you have the basics, right? Then it becomes very important to know how to apply these models to figure out what is the right kind of machine learning model for certain scenarios, because not every model will be the right model. Like kind of different type of asset or different type of market environment, things like that may actually ask for different kinds of model. And so there's no specific, you have to learn this, and then you will definitely know how to do have a perfect model can make you lots of money and all that. It's actually very scenario specific. So understanding the characteristics of models and applying them correctly is, I think, more useful than being specifically like, okay, I must know this type of unsupervised learning model. This very specific advanced one that just came out 2 months ago. No, not necessarily. It's more about applications.
And thank you, Miss Yiping, on explaining all that about specifically the gap that separates strong and average applicants. Okay, I have one last question for Mr. Ting Jing. Okay, Mr. Ting Jing, when you review someone's work at Optimus, whether it's a backtest, a strategy document, or maybe a piece of code, what is the specific detail that tells you that this person understands how the markets work versus someone who is technically smart but financially naive.
So at the start, I would say that my 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 company way of doing quant finance is less about factor and it's more about going through technical analysis, fundamental analysis, and going through rule base to find out the alpha of the strategy. So going through while I go through the work of my colleague, so is basically we are looking at what can go wrong lah. Any risk that inherent. The first one is inbuilt, but then sometimes especially when newcomers come in, they do not include it. So the first one will be the cost, which is if you are trading in any market, you need to expect there's slippage, which means that you want to get the price, but you cannot really get it. And then there's spread in the market. So all this you need to consider while doing your testing, back testing especially. And if you don't consider that, then your equity curve may be very good looking. And sometimes when you are doing your back testing or forward testing, you even have very good profit, but then you need to see another aspect is are these profit concentrated in the few trades? All these are some very 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 technical thing, but then it's something that will affect whether your back test will really reflect in your real trading scenario. And also doing all this work testing about this other strategy, we need to look into where are we getting the money from, whether it's from the momentum, and sometimes we do not really want to overfit the backtesting towards a very overfit actually means that you are giving too many indicator and then you are fitting along the entry and exit of the instrument and then you are actually getting a very high profit because you are really fitting the line of the entry, the best entry and the best exit. So all these thing you need risks because all this may look good in your back testing, but then it definitely will not be shown if you are really trading that instrument in a real world basis. And yeah, so the end of the day, everything you need to think like what if you get a very nice, beautiful equity curve, the one question that you always need to ask yourself is, what can I do wrong or what did I do wrong? Instead of looking at the good equity curve, like I'm going to be the next billionaire because of this strategy. So it's more like you need to find way to tackle your own strategy. Like this could be the wrong, you need to find, because like what Murphy law says that anything that can go wrong will go wrong. So backtest is one thing, real trading, after backtest, you need to do a forward testing, and then you even need to paper trade for a certain timeline, and then only you release it for a real trading. So I would say that all these minor things that can go wrong, which are risks towards the strategy, need to be tested and to have that included so that everything is feasible and realistic lah, I would say. Yeah.
Thank you, Mr. Jing, for such an in-depth explanation on backtesting and instruments. Wow. And on the skill sets for graduates like me to break into the quant finance industry. So that being said, let's move into our final topic of the day, how to break into the quant finance industry. I believe most of the participants here are incredibly keen and extremely interested in this specific topic. So without further ado, let's start our final topic. So there is a common misconception or maybe assumption that quant finance is strictly reserved for people with pure computer science or engineering degrees. So for finance and business graduates in Malaysia who wants to transition into quant finance, like a traditional engineering degree, maybe civil engineering, electrical engineering, etc., or a heavy coding background from comp science, software engineering, etc. So, what does a realistic 12 to 24-month roadmap look like to bridge that gap and enter the quant finance industry? We'll go with Mr. Hajin first, and then Ms. Yiping, and then Mr. Ting. Would that be okay? And that being said, Mr. Hanjin, the floor is yours. Thank you.
Yeah, sure. Thanks, Brandon. Yeah, I think like Mr. Ting has pointed out, quant finance is so broad, right? So depending on like which part of it that you want to break into. So of course, let's say if you are talking about you are breaking into the field of options trading, um, options quantitative strategy, of course, you will need to build up your domain knowledge in that. You need to understand things like implied volatilities, what are the things which are affecting the pricing of these uh, options, at least from the vanilla options that kind of instrument first. So, and then of course, if you are looking into in terms of more quantitative investing kind of quant finance, then perhaps it's more about understanding statistics, understanding probabilities. So I think this one I previously have also mentioned before. Basically, it's about your foundation in statistics and probabilities. And of course, since this already, if you already have finance background, you already have the domain knowledge in terms of at least you know how the financial markets work. Sometimes I think we cannot think about it in terms of just quantitative kind of way. You also have to think about it in terms of your domain knowledge. So if you trade Bitcoin, of course, you will need to understand what's are the factors affecting Bitcoin. If you trade equities, then you would need to understand what are the underlying market factors, interest rates, Fed decisions, all these you also will have to understand. So it's not so much about just having the statistical and probabilities knowledge, but statistics and probabilities are very important for you to have a strong foundational knowledge. So for me, myself, I also come from actuarial finance background where I don't have any coding experience. I didn't have any coding experience when I first joined the industry. So basically, it's more I did it on a self-learning and also did it on the job. So I think the second one is about build up your coding knowledge, because even though you already have the AI tool, you cannot just ask the AI tool to create everything for you. You will need to understand coding, in my opinion. You still need to have the foundation in terms of coding. And once you already have built out your coding knowledge, then I think you can start to build projects. So basically, you can try to build real world in terms of real world back testing, in terms of looking at factors, collecting the data, all sorts. Basically, you try to go through the entire workflow in terms of creating models and eventually creating portfolios. Because in Malaysia, I think in Malaysia's context, you don't have the kind of a very specific quant role. If you are talking about quantitative investing, you don't have somebody who just do quant research and don't do the back testing part. Just trying to ideation part, basically coming up with the idea and then test just the ideas and test the statistical significance. So you cannot just be focusing on this. Basically, you will have to try to do an end-to-end process, in my opinion. Yeah. Uh, I
Thank you,
think that's
Miss.
all I will put. Yeah.
Sorry about that. Thank you, Mr. Han Chin. Thank you for that is incredibly well phrased and for breaking all that down. And wow, I did not know you were from an actual dance background. Okay, thank you. So let's go on with Miss Yi Ping to share her view on a realistic 12 to 24-month roadmap to break into quant finance. The floor is yours, Miss Yi Ping.
Yep. So I think not gonna lie that it is technical kind of role or job. So you have to have your skill set or your resume has to reflect the kind of job that you want, right? So if to break in, then you would need to have or demonstrate that you have a knowledge, the technical skills. So you cannot be like, oh, I came from finance, I want to be a quant. I know nothing, but please hire me anyway. So you cannot have that lah. So at the end of the day, you do need to have Python understanding. You need to have, if you are doing the machine learning type of or factor investing type of quants is what you're targeting, then you need to have the machine learning kind of understanding. If you're going like Hanji mentioned, if you're looking into derivatives, then you need to show that you have all those kind of knowledge or background before you kind of try to go into these jobs. Because to get your foot in the door, to get the interview, then you have to show that you have the technical basis. Then after that, to get the job, then you need to show you have the curiosity and also the willingness to do the work to learn basically what it really takes and basically have all the so-called attitude, like you have the right attitude that fits the kind of work that you're looking for. So it's still in finance at the end of the day. So there is a risk management component to it. Without getting too much into all the kind of details, right? At the end of the day, you need the right skill set, right, to get the interview. Then after that, when you try to get the job, then you need to show you have the right attitude.
Awesome. Thank you, Miss Yi Ping, for the insights. Now let's have our final panelist, Mr. Ting Jing, to share his view on a realistic roadmap to break into the quant finance industry.
Yeah, so on top of all those technical skills, obviously, you, if I were, like, let's say, back to fresh graduate and then I want to apply into and get into a quant finance role, I'll actually try to, what I will include in my resume or even during discussion in the interview will be, I will I will create a portfolio in, like, let's say, some some broker actually support all these quantitative finance or algorithmic trading stuff. So from there, you need not to build the entire infrastructure, because infrastructure is very code based, and then you will definitely need to be very savvy with all the programming language. But then to have a real kickstart, you may actually look into the strategy first. Strategy compared to the infrastructure of the entire algorithmic trading, strategy is a smaller part of it, and is more relatable to even a finance student, because we may look through technical analysis, we may look through fundamental analysis, and we can have them as a rule base. And to implement that in certain broker is actually very feasible nowadays with all those API provided, and you can actually create a mock portfolio, but is a automated basis. And then from there you can create different portfolio and to demonstrate your strategy to demonstrate that you have a little bit of understanding about this area of quant finance. And even better if you can use real money lah, but then it's up to you. So there are many platforms, and now it's very accessible to a lot of retail, and anyone can open an account and then put some code and then write some code and then connect to their back engine lah. So with this, it's definitely will differentiate your portfolio, differentiate your CV, because you say you really backtest, you really do the hands-on stuff using a real world scenario lah. So I believe if I was back to my fresh graduate time, I will do that to differentiate myself if I want to break into quant finance role lah. Yeah.
Wow, I love that. Thank you so much, Mr. Ting, for talking about all that. Before we end this segment, I actually have a question for Mr. Hanchin. Mr. Hanchin, reflecting on your career in directing portfolio strategies in Fintonia Group, as well as a quant researcher and manager at CIMB and Maybank. The question is, breaking into this field, when you are assessing a candidate from a finance background, what specific questions or problems do you use to evaluate their quantitative reasoning?
This kind of job interview for this specific quant role, I would have to ask them about quant specific questions. So things like, obviously, maybe the candidate has already come up with some models. So I would like to perhaps ask him in what circumstances that your model will break. So I would like to know whether you understand your model well. It really depends on when do you know that your model may not work. So things like I think it could be something like let's say you have a model and then you say that it's a rebalance like once in 2 weeks, which is usually is considered as quite common in factor investing. If the rebalancing is every 2 weeks, is actually quite frequent. So you would like to see maybe if you delay the execution by 1 day, will your model still work or not? So I think these are the kind of basically the candidate will have to be coming out with scenarios where where they know that it's possible that the model may break. So it's not everything about your model will always work. So you need to understand also what are the circumstances that your model may not work anymore. So yeah, there's perhaps one way that I could test the candidate's understanding.
Understand. Thank you, Mr. Hanchin. I actually have another question for Miss Yiping. Miss Yiping, reflecting on your experiences at Kenanga, automated investment platforms make decisions on behalf of thousands of clients at once, which is in Kenanga, lah, which creates a massive responsibility for Kenanga to protect your clients' capital. So I wanted to ask, for finance graduates like myself who wants to break into the digital wealth or the quant finance industry, how can I, or maybe they, demonstrate a strong grasp of these risks, for example, operational risks and some sort, during the interview process, and use that knowledge to stand out if they lack a heavy programming background? For your CV.
For understanding of risk, you don't need to have a programming background to understand risk because it's pretty universal. But the part that programming plays into it is to understand how then to code the so-called solution. What are the protection measures that you can implement into the portfolios to avoid big drawdowns. So there's two parts for it, right? There's one of it is being capital outflow, right? Which is becomes like what we were discussing earlier about cash flow management. The second part of it is actually so-called like downside protection lah. So I mean, normally you can just I'll just ask back to like the candidate, right? Like how would you implement robust downside protection measures in a model, like maybe you can describe a model and then describe how then you prevent or kind of manage if something like let's say 10 asset model, one of it really crashes like 20% per day, and what would you do? So these are all conceptual, right? It doesn't have to be about coding, but the coding part only comes later. So once you offer a solution, right, then how do you put it into place in your model?
Understand. Thank you, Miss Yiping, for explaining all that for answering my question. Okay, I have one final question for Mr. Ting Jing. Okay, Mr. Ting Jing, since you previously mentioned, like during topic 2, that you hold both the CFA Charter and the CQF, which is the Certificate in Quantitative Finance. So, can I ask, how do you see the combination of these two credentials playing out in live markets? And how does merging fundamental market logic from CFA and the CQF with quantitative engineering change the way you manage investment risk? What is your Mr. Ting?
Okay, so I would say that CFA give me a very good breadth about finance, which we are learning different aspect, different instrument and different kind of fundamental skills and also ways of diving into different industry in between finance. And CQF is very particularly into one aspect of the finance, which is quantitative finance. Even though it doesn't look overlap, but then a lot of things nowadays you can actually have can cross multidisciplinary to look into the area. So for example, for fundamental analysis, a lot of things you may think that only number based, for example, financial statement, for example, price data can be quantified, but then even textual information, you can actually quantify them as well. There's called natural language processing, where you can generate sentiment score based on news, based on different textual sources. So actually, both complement each other, and I would say that not just there's actually a lot more thing to dive into. Fundamental analysis alone itself has different kind of strategy. There are something like global macro, there are something like all weather strategy, there are something like value investing. So fundamental analysis actually, oh shit, sorry, there's an echo. So finance wise is very broad based, and then if you are someone that want to be systematic, then the CQF will allow you to fasten your learning process lah. But then to blend two together, end of the day is how do we manage the risk? Some risks may come from some risks are quantifiable, some risks may be more towards fundamental basis. So it's more like you have one additional lens for you to see the market. End of the day, both objective is to make return, make money. I mean, both fundamental analysis and also quantitative finance analysis both have the common objective, is to help your portfolio to gain higher return. It's just a matter of adding a lens for yourself to able to assess the return, the risk, and also how many. Actually, every strategy can be summarized as return, risk, and also whether you are diversified enough. So with these three lens, you can assess the return of one strategy, whether it's fundamental, technical, or factor based. Then you assess the risk. Then you assess whether it's a diversifiable within for the instrument for your strategy. So you need not to follow one strategy. You can always blend them together lah. Yeah. Back to you, Brandon.
Thank you, Mr. Jing. Wow. Thank you for explaining all that. And also about natural language processing. Wow, that is certainly the first time hearing this word for me. And no, thank you for answering our final question of the day. So that being said, I wanted to say a huge thank you for our brilliant panelists for your time and for breaking out these topics so phenomenally today. So that has been a fantastic conversation, and I personally learned a lot about quantitative finance, and I believe the audience did too. So our participants, thank you for so much for your time. I know we have plenty of questions lined up. So I am going to pass the floor back to our MC, Jason, to lead us through the Q&A segment. So give us a moment, everyone. Thank you, everyone. And Jason, the floor is yours.
Thank you, Brandon, and the panelists for the insightful discussion. So we will now move on to the Q&A session. So for the participants who have not submitted any questions through the chat box or given to the committees, you may do so through the Slido by scanning the QR code available on the screen shared by Fatin. So we will try our best to address as many questions as possible based on the time. So yeah, I'll pass the floor back to Brandon to moderate the Q&A session.
Okay, looks like we have our first question of the day. Okay, an interesting question. So, someone asked, for someone already working in fixed income, how do they switch to quant finance? Does anyone want to answer this question?
So, for example, fixed income, you may look into a famous some more relatable to fixed income area kind of strategy. For example, the one that I mentioned earlier was all weather portfolio strategy. So what does this all weather does? It's actually a strategy that can allocate across different instruments, including equities, including fixed income, equity, I think less on derivative, but then mostly are these two combination. And from there, the all weather actually they are trying to find a mixture of instrument that you can actually balance out all the downside. So one, if you are investing in one instrument, then you may have high return, but then your risk is very concentrated. But then what the all weather does is they allocate across emerging market, they allocate towards the advanced countries and in different market. So from there, it's not just it's like a stepping stone for you because you already know the thing about fixed income. So everything boils down to return. The fixed income has a return. They have a coupon return. There's a price fluctuation return, and equity also the same. They have dividend, and also we have the price fluctuation. And you need to quantify the risk. And the main thing is if you are investing in only very concentrated of stock, then you are not diversified, then your risk is also will get very high. So what the all-weather portfolio strategy does is allocation towards at least 15 instruments, and then this 15 instrument you can still achieve the return, like let's say 10-20% per year, but then your risk already minimized because you are actually balancing out across different instruments, and this instrument actually have particularly correlation will be negative or even small, because all these instruments are very different in nature. When you're comparing fixed income, you're comparing equities, all these are very different in nature. So by diving into something you are familiar, since you are familiar with fixed income, then you can look into this kind of called all-weather portfolio strategy. You are able to actually have a advantage because you are already knowing 1/3 of the picture lah. You are very familiar with the fixed income. Yeah. And this is also a very quantitative strategy for you to dive into. Okay.
Thank you, Mr. Jing, for that. Wow. Okay. Our second question. This is for postgrad. I think it's for someone from a postgraduate background. So, in terms of education, which institution in Malaysia offers a master's program in quantitative finance? Does anyone want to answer? Maybe Mr. Hachin or Miss Yiping? Or Mr. Ting Ting, if you know the answer as well. Anyone. Good.
Okay, so actually back 10 years ago when I actually wanted to do quant finance as a degree, and even back then for like Hong Kong, Singapore, or UK, or even US, they are they think that it's too early for people to actually dive into a degree in quant finance, because degree is better for you to have a broad knowledge base. So most of the time, a master in quant finance is a more relevant one, if especially after you are graduated with a relevant degree, either finance or programming, computer science. So master wise, I would say the best of the best will be still in US, but then the hurdle is very high lah if you want to get into them. Ivy League, like for example, Columbia, and things Princeton, UPenn, all these are very famous for their quant finance, and there are actually people around the world trying to get into that. For UK as well, for Malaysia, there are also a few university offering quant finance. For example, I remember there's such option. And yeah, Singapore, Hong Kong as the financial hub also have this master for you to take lor. For example, NUS, NTU, Hong Kong, UST, Hong Kong U, all these are very famous for their quant finance. So getting in, if you want to get into a master, then all these are quite a good option for you to try out lah.
Thank you, Mr. Ting Jing, for that. Wow. Okay, so basically, for the person who asked that question, if you want to get into quant finance, a master's in it, get to NUS, NTU, HKUST, or Columbia, or the UK, anywhere. All right. Thank you, Mr. Ting Jing, for all that. Okay, I'm gonna answer one question from the chat from Vince. Wow. If someone wanted to build a world-class quant finance firm in Malaysia, what would be the biggest obstacle? And would liquidity be the limiting factor, or is it talent, infrastructure, or regulation? Like, are there any bigger challenges than this?
So, uh, okay, I think I'll answer in the context of, because it's not specified here what kind of quantitative finance firms. So let's say if it's a quant fund management firm. So I think obstacles, I think it's always about AUM. Of course, if you already have the relevant AUM, of course, it's fine. Whether you can garner enough AUM or not, of course, that depends on the market. Clients understanding about quant strategies. Are they willing to pass you the kind of money to manage? Uh, Even if they don't fully understand the kind of strategy that you are running. So I think that's quite important. A lot of time clients want to know the methodologies, how are all these funds being managed. So I think that's one part of it is about whether clients acceptance in terms of these kind of strategies. In terms of regulatory, I think if you are just looking for you have your private clients, you are not looking to launch retail funds, but it's more in terms of your more wealthy kind of clients, then I think the regulatory part is not so much of a concern because nowadays in terms of Malaysia's investment industry context, I think regulators they want our industry to be more competitive in terms of fund management. So it's actually not that tough for you to have these kind of firms. In terms of regulatory barrier, I think compared to 20 years ago, it's nowadays it's easier for you to set up these kind of fund management companies. Yeah, I think talent wise, I think Malaysia has the talent. Yeah, you just need to find because the perhaps one of the problem with the Malaysian industry is there's not quant is a quite a niche industry so you don't find a lot of people who have the relevant working experience as per to what you are currently want to do. Let's say if you are talking about quant asset management, do you even have the kind of people already working in this industry or not? I think that's a it's not so easy to find so in terms of Malaysia. But if you're talking about just talent wise, I believe Malaysia has the talent definitely. Yeah.
Wow. Thank you, Mr. Han Chin. Malaysia has the talent. Wow. Okay. Thank you for the inspiring words for our fellow Malaysians here. All right. Now I'm gonna move on to our Slido, our QR code from the QR code. Okay, our first question from Hakimi is quant a good starting point for beginners in investing? Does anyone want to take the floor on this?
Very general question. You have to be quite specific, quant in what way, right? So we're very basic sort of quantitative trading or so-called algorithmic trading is pretty, I don't say common now, but it's a pretty accessible way to get into investing. But at the same time, in any kind of investing, if you don't know what you're doing, then you maybe want to be very careful before you actually start putting real money into it. So this is just another path or another direction, and it depends on what is your so-called investment thesis or what do you believe in, what is your method. Because if you believe in fundamental, then you should look at the fundamental way to do it. If you believe in technicals, then you can look into algorithmic, So it's all just different paths. And sometimes it's just what suits your own skill set or interest that should be as a beginner, that should be what you then start to add your knowledge into.
Understand. Thank you, Miss Yiping, for answering. Wow, there are different strategies in investing and some sort. Thank you for all that. Okay, our second question, also a fairly general question, but it's okay. Let's ask anyway. How hard is it for a finance student to enter the quant finance field?
Okay, so if you're talking about because it's a very general question. If you're talking about the knowledge to equip the knowledge, then there's a lot of resource available online nowadays for you to access, then that part is easy and that should be the first step. But let's say you want to get into a position or a role in a company doing quant finance in Malaysia will be relatively, I mean, not just in Malaysia, in Singapore, in Hong Kong, they are a very demanding role for you to go into because I have a friend in Singapore and then it's very hard to get into, but once you get into, then it's still hard because you really need to perform. If you don't perform during the probation, then very likely you are not getting further in the company. So to equip yourself first, and then if you really want to get into the role in Malaysia, for now still very limited. But then if you want to perform this for yourself, the door is always open for you because there is very accessible in certain broker. They have API for you to really generate. But if you want to go into professional level, definitely is relatively less supply of vacancy and there's a huge demand for this role lah. Yeah.
Stan, thank you, Mr. Jing, for that. Now, our next question would be, I'm going to combine both two questions at once since they're quite familiar. So this one is actually a bit connected to our previous question. So what areas of quant finance are growing the fastest, and what is the best age range to get into quant finance? Does anyone want to answer?
I think in terms of areas of quant finance which are growing the fastest, even though we're talking about AI can help us with coding, but surprisingly, I think what I see is that quant developers kind of role is really one of the areas which are kind of growing. Basically employers want people who can create strategies that you can code it and run it. So if you say you have some kind of strategies, but how are you putting it into real world use? You still have to everything have to be inside your code, and you need to create the kind of infrastructure as well. And in terms of logic, is there any chance that your algorithm could break? Yes, this also relatable to one of the strategy that we run, which is currently run is market neutral trading. Crypto market neutral trading, what's the riskiest there's one kind of risk that you need to really manage well is when you are doing cross exchange kind of arbitrage. You have a long, let's say you have a long Bitcoin over here, you have short Bitcoin futures on the other exchange. So you kind of need to manage this risk because you are not basically you have the leverage, and if Bitcoin prices move very quickly, what is the algorithm for you to unwind? So these are the things that a quant developer will be able to build. So I think that's one part of it. Manage to turn your ideas into execution. That's kind of important. So that's one area. Of course, the other area is in terms of risk management. I think risk management in quant finance is, I think in Malaysia is always highly sought after. So risk management has been around for a long time, and they emphasize a lot in terms of quantitative knowledge. So that's another part of it, I think. And then in terms of best age range to be getting into quant finance, I will say that it's as early as possible. Yeah, because nowadays I think there are a lot of kids who are already very proficient with programming even during when they are very young. So these people, they may have the advantage in terms of coding. So what they need to do is just build up their domain knowledge. Yeah.
Wow, thank you, Mr. Han Chin. Wow, I might have already lost at the starting point when kids around my age are already is starting, when they are very, very young. Wow. Okay, thank you. And for risk management, wow. For the person who's asking this, yes, look into risk management. That is advice from Mr. Han Chin. Okay, our next question from the chat box. This is a really interesting question. Wow. Okay. Many people believe quantum computing could eventually transform finance, particularly in portfolio optimization, derivative pricing, and risk management. So, from your view, our panelist view, what time horizon are we realistically looking at before quant computing begins to leave a meaningful impact on quant finance? A very complicated question. I think you need to think a bit for this. So, if any of our panelists want to start, you can just hit the audio button and go at it. Thank you.
I mean, they're not going to pretend to be an expert about quantum lah. But to begin with, right now, it's still very, very far. Because anyone who has access to a quantum computer is either a mega tech, company or a government, right? So it's not something accessible to you and me. And even now, what they are doing with quantum computers, it's not solving any problems, it's just demonstrating a capacity, right? So there's not any particular, application case that has been put into place yet. Now, I don't know how fast that these things are going to move, but I mean, if I were able to pick up a quantum computer right now, right, then the first thing I do is take everybody's Bitcoin, why go into finance, well, what question does it really solve and how do you use it? How do you apply that use case? No one has that answer. Yeah, so I think it's still a pretty long way away. And until then, we still need to, have make some bread and butter on the table lah. So we still have to kind of stay grounded and look into the skill sets and all the things we need to do to have a daily career lah. I mean, if anyone else has any comments, please go ahead.
Jing, no comments. How about Mr. Ting? Any comments?
Quantum computing obviously is okay. So like last time we have computer, we actually commercialize it, but then quantum computing, I echo with Yiping, probably will be helped by government or helped by bigger mega tech company to commercialize to everyone using it is still a journey, a long journey ahead because quantum computing is there are security measure. Even the reason anyone got follow one AI software called Claude, they have one model called Mythos. They actually release it and then they actually retrieve it back because people are using it to hack other people's computer and security files. So with quantum computing, you are looking into even higher grade, which means that all these security issues, cybersecurity issue, is something you need to resolve. So I don't think it will be commercialized to like many company or many individual can hold such quantum computing. It's still a very centralized technology to be held in government level or a very high level thing lah. So I would say it's still a journey ahead lah. It's not because we cannot hold it, but it's the security issue lah.
Thank you, Mr. Ting, on that. Okay, so it is a very long journey for quant computing to eventually transform and leave a meaningful impact on finance. Thank you. Okay, I'm gonna ask a few more questions before the end of the session. Okay, so a quick one. As someone who's trading fundamentals, market structure analysis, do you think a quant would have done better? Does anyone want to answer?
Can you repeat the question?
Just give me a second. Uh, okay. So someone asked. So I'm assuming this guy is a trader or something. Okay. So if he's trading fundamentals, doing fundamental analysis and market structure analysis, okay, this is him. So he wanted to ask, would a quant analyst, from a quant firm or something, would have done better as compared to a person who are trading fundamentals and market structure analysis, like someone who isn't a quant?
I think there's no right answer to this because if you are a fundamental analyst and if you are the one of the best fundamental analysts, you understand market structure, you understand what's the catalyst to the companies, what's the risk of it. I think if you are one of the best, of course you will do very well. But in terms of quant analysts as well, for quant analysts, there are also top firms like the ones that being mentioned is Renaissance Tech, which managed to generate something like 30% annualized yield. I think probably close to 30% annualized yield returns over the past 20, 30 years or so. So of course, there are always the good ones and the whether it depends on whether you are the better quant analyst or and you are, of course, you compare against the better fundamental analyst. I think both if you are good in fundamental analyst and you have been generating good excess returns have been outperforming the markets quite consistently, I don't think there's any valid reason for you to kind of like say, oh, I want to switch to quant. There's no reason for it. Similarly speaking, if you are already doing very well in terms of quant portfolio management, you have been generating very consistent excess returns, there's also no point for you to make a switch into uh, fundamental analysis. Because even from quant point of view, it's always we just look for patterns, right? And in terms of looking for patterns, it's also very good that you understand the fundamentals part of it. Like if you're talking about valuation, price to earnings ratio, can you just apply it across all industries? You probably couldn't apply it across all industries, even in terms of quantitative analysis, because like banks or some high capex industries, you probably don't value these companies in price to earnings ratio. So these are the kinds of things that I think for quants is always helpful for us to know the fundamentals part of it. But you know, in terms of your mindset, even though you think about it, everything in terms of risk, reward, probabilities, but I think the domain knowledge definitely helps. And in terms of fundamental analysis as well, if you can think about it in terms of, let's say, if what you are doing is currently not working very well, then perhaps you can also think about it in terms of probability. So instead of like having high conviction into one stock, you need to think about um, is what if this scenario didn't turn out as expected? What would be your potential loss? So let's say you not only think about oh, if this catalyst happen, maybe this stock is going to go up by 30%. But what if it didn't happen? Is it going to go down by 30% as well? Then in terms of risk reward, then you probably think that, oh, maybe it's not good to enter into the trade anyway, even though that there's a potential that I can make 30%, but your downside is equally high. So I think it could kind of like complement each other in terms of fundamentals and quants, but you just don't have to make a drastic switch into another field if you are what you are doing is already working very well for you. Yeah.
Thank you, Mr. Hunch, on that. Wow. So basically, if you're good in fundamental analysis, just stick into it. If you are good in quant finance, stick into quant finance. No need switching. And as Mr. Haji said, they complement both each other really well. So there's no reason to switch much. Right. Thank you, Mr. Haji. Okay. Our second last question. Okay, this is a question from a student. So person. He wanted to ask whether your course name in degree, for example, or maybe I'm studying finance, I'm studying economics, would that determine my position in a company, for example? Because if I'm assuming this person wanted to pursue a career in quant. But the thing is, the degree's outline does not consist of statistics or probabilities or basically any heavy mathematics courses because as you know, quant finance is mainly in mathematics. So this guy wanted to ask whether the degree name determines the position in a company, or maybe some other degree, for example, economics, because economics is that some say are mathematically harder than finance because there are more statistics, there are more probabilities, while finance is more on time value of money or some sort. So what's your take, our fellow panelists, on this question?
If you are trying to get a job in a quantitative role, and then you don't have a quantitative educational background, then you'll have a hard time. So like even before, trying to find the role, then you have to ask yourself whether what you're bringing to the company is, suitable for the job that you're looking for. So if you do want to get into the industry, then you definitely have to demonstrate that you have the understanding, whether or not it's from degree or courses or anything else. You still have to demonstrate an understanding. So then you have to design, what you're doing now, like, is it really the path to where you want to be? And you have to design your kind of life or plans accordingly.
All right, thank you, Miss Yiping. Okay. Thank you so much, everyone. Unfortunately, that is all the time we have for the Q&A segment. Although, yes, I know that was the second last question, but I think due to time constraints, we are unable to do so. So a huge thank you once again to all our brilliant panelists, Ms. Yiping, Mr. Jing, and Mr. Hanxin, for your time and for sharing such phenomenal insights during the session. And to all our participants, thank you all for coming. Although that my job here as moderator is done. And I officially will pass the floor back to our MC, Jason, for the final closing remarks.
So as we come to the end of today's webinar, I would like to extend our sincere appreciation to our moderator and panelists for generously sharing their experiences on quantitative finance. We would also like to thank all participants for spending your Saturday morning with us and for contributing actively throughout the session. So we hope that today's discussion has provided you with a clearer understanding of quantitative finance, the role of quantitative professionals in the industry, and the opportunities available for those who are interested in pursuing this field. So once again, thank you for joining us. We wish you a pleasant day ahead, and we look forward to seeing you at future CFA Society Malaysia events. Thank you and goodbye.